And a very good morning and welcome to you here from Cheltenham, Gloucestershire. It's the new year. In fact, it's been going for a couple of weeks now. It's the 13th of January. I'm Paul Archer, so let me welcome to our first live stream, CeMAP live stream of the year. Hope all is well with you. I'm in my new studio now. We're just moving in, so we're kind of half doing a live stream, half not, but next week's will be absolutely pucker with lighting and all sorts of good things like that. Got a purpose-built basement here, which is great, so we've got no noise, no issues, not what's going on as well. So, how are you? Hope you're well. We've got almost a couple of thousand people on the YouTube channel now subscribing, which is fantastic. Really good news all around. So what have I got for you this afternoon, or this morning, I should say? Depends on actually where you're coming from around the country or around the world. We talk to people in India, Bangladesh, all sorts of things around the world, so different time zones. I want to talk about money laundering, and I want to talk about my 10 top tips for the mortgage sector moving forward. Just want to give you some ideas about what's going on as well. Read in the press over the last week, been really busy since the new year started. Been working with lots of BDM teams as well, which has been fantastic. About the 5th Anti Money Laundering Directive that's just come in from the European Union. And yes, we're still kind of a member, aren't we? I don't know what's going on anyway with Brexit. But the point is, though, the new one's come in. I'm going to talk about it more next week in some detail. But it's quite funky and clever, because one of the biggest things about the new anti-money laundering, number 5th one this is, directive, is that it requires that you have access to an online method of checking somebody's anti-money laundering. And Experian do a really good one. They do some special checks. And the whole point is it streamlines the process. You got rid of paperwork and things like that. I remember back in the day, this was years ago, I had a colleague who was a bit sharp, a bit naughty. And what he used to do as anti-money laundering is he used to collect the customer's identification. And he used to take their passport, which is fair play, you know, photograph the passport, etc. But what he used to do is keep the passport on file to stop them going anywhere else for their mortgage broking business. Totally naughty. But of course, that's all gone now. The whole point is it's all done electronic. And the clever thing is, of course, that the electronic method of checking is pretty foolproof. Clever stuff, very clever. Somebody was reporting, one of the networks was reported to say that no recorded incidents of money laundering have happened when there's been electronic verification going ahead. And I just think that's really, really quite funky and quite clever, don't you? Makes you think, actually, because personally I've got a couple of issues about anti-money laundering for me. I've redirected my posts for the last year or so, because I've been in rented for 2 years now. I'm in owner occupied. Of course, that doesn't work so well for your anti-money laundering checks. It puts your score down. So little things like that come into it. I've been abroad. I've transacted currency transactions abroad as well. It's all electronic footprints of these things, so of course they'd be able to find me out along the way as well. But just wanted to catch up on that, and we'll talk more about that next week with you along the way. What I do want to do, though, is to talk to you a bit more detail about my predictions for the mortgage markets for 2020. Now, these are mine. Don't belong to anybody else, and that's fine. They're my thoughts about for the next year, maybe 2-3 years hence. And yeah, I want to capture them. I want you to think about them to see how your mortgage broking business is progressing, the differences you're going to make maybe to the industry. I don't know what your plans are, and how you can get a competitive advantage and look after customers along the way. There's 10 for you. Going to use the whiteboard to just put some sort of key headings really to help you along the way. Okay, let's get down to the first one for you. I'm going to put it up the top there for you, and I'm going to call this one DIPS. Yeah. Now you may not know what the phrase DIP is. It's called Decision in Principle, brought about pretty much by a 2014 Mortgage Market Review, which abolished those lovely things called multipliers of income. And now, of course, each lender has their own method of assessing affordability. It stands for Decision in Principle. And if you want to get a sort of a yes from a lender before you put a case to them, you want to get a decision from that lender that they're willing to take the case on, otherwise you're going to be wasting your time. It's called Decision in Principle. And they use their own affordability calculation to do that. Now, the problem with DIPs is that everyone's got their own. They've all got their own DIP engines, as I call them, usually on their websites. Brokers can go on the key into their portal and access the customer's details onto the DIP, and it says yes or no. Some DIPs are very good, some DIPs are appalling. Some DIPs sort of, seconds later says yes, and then when you submit the case, they say no. But of course, if you're a broker and you're looking at a number of different lending options, you might want to hedge your bets and do a couple of DIPs, because this makes extra work. So what they're creating now is what we call a DIP of DIPs. It's very clever. So you go online, you key in the customer's details, etc., the property if you've got it, etc., and this engine then goes off to various lenders that fit your criteria and do a DIP with these various lenders, all done soft credit searches. So it comes back with a number of yeses from lenders, or potential yeses. So you can then sort of decide which one's appropriate, which one's not. I think there's a real big time saver that. I think that's a great thing to go for. So that's DIPs. That's mortgage market prediction number 1 for you. Never predictions without some talk about rates, of course. Interest rates. Interest rates are very, very low at the moment, lowest they've ever been, particularly long-term fixed rates as well. Will they remain the same? Probably. Who knows? But interest rates aren't going to budge much from what they are. We've got the Brexit. We've got another deal about to be sort of negotiated. Awful lot going on in the world at the moment. Middle East issues, crisis, trade issues with China. Lots of things happening. Hong Kong, Taiwan. Therefore, I think interest rates will remain the same. Talk more about the economy in a second, but I think they're going to remain fairly low. The other thing about interest rates in the mortgage market is 95%, this was figures from Mortgage Strategy, 95% of mortgages granted now are fixed rate. So, of course, variable interest rates make no difference to people. So the government, of course, using interest rates to adjust the monetarist policy is pretty worthless. So that's just the way to think about interest rates. They're going to stay pretty much the same. Inflation, I think, is going to be controlled for much of the year. Another one for you, and I call this the Bojo Balance. This really upset my daughter-in-law. Bojo Balance, my stepdaughter, I should say. Just up in Scotland, Bojo Balance. Bojo stands for Boris Johnson. Love him or hate him, Boris Johnson is now our Prime Minister and will remain so for 5 years, whether you like it or not. The point is, though, that the Bojo Bounce, as I call it, is the economy bounce as a result of having a secure parliament with an 80+ majority. Now, that's good for industry. That's good for business. That's good for the economy. Whether you like it or not, it's good. It's stability, it's security, 5 years of the same kind of policies which the city like, which will actually have a bounce to the economy. Now, we've talked about downturns, we've talked about recessions for a long while now. But since 2008, when you had the last financial crash, which was, 12 years ago now, crying out, that was a long time ago, we've had growth since then, some negative, or mostly growth, but very tiny growth. It's been like 1.5% growth per annum of gross domestic product, GDP. Now that's great, but normally you see when you come out of recession, after a year of stilted growth, you then have sort of 3, 4, maybe 4.5% growth. That's the UK have ever produced. We've not had that. We've had stilted growth. So this underlying growth is there ready to go. And I was reading up some figures that companies in the UK have a treasure chest of money. There's estimates of about £140 billion. It's a lot of money, which companies are holding in their bank accounts, ready to invest. So that's pretty cool around, isn't it? Because that money will go into the economy, will boost things. It's a bit like the government spending 140 billion of government spending. It's the same effect. It'll boost the economy. I think we'll have a bounce this year. I think we'll have a good economic bounce. Whether we'll downturn the following year, who knows? Probably so. But so that's another prediction for you as well. Some technology, some more technology for you. This one's called open banking. Now, I've talked about open banking before, but it's beginning to really take off, and I call that APIs as well. Yeah, put that one in there for you. Not APR, but APIs. Open banking is going to take off this year. It's been bubbling nicely now. Open banking allows your lender to talk electronically to your bank. So rather than having paper statements where they check things through the underwriter's algorithm talks to the bank's algorithm and can search your bank statement and all your records to find out exactly what's going on along the way. And that's absolutely the way it should be. Now, the thing about open banking is it speeds things along. But what you've got is APIs on steroids. Now, an API is a piece of computer code that allows one computer to talk to another computer. And that's where things are starting to really rock and roll. Now, for example, you've got in the mortgage process, you've got brokers, you've got lenders, you've got lawyers, you've got surveyors, you've got land registry, you've got local authority. They've all got computer systems. And typically, we talk to them via paper, or at least email anyway, attaching a PDF, which is pretty much like the old post, isn't it? But these computer systems will start to talk to each other. So you make an application via your own computer, that whizzes off to the lender, who then whizzes off to the bank to check your open banking. It then whizzes off to the surveyor, which does the survey and talks very quickly, because often surveys are not done face-to-face anymore, done electronically. Whizzes off to the lawyer, who's progressing things nicely. Whizzes off to the land registry to check title, get all the... I mean, you could foreseeably see a mortgage happening in minutes. You know, why not? I mean, I went to buy a car just before Christmas, and my loan was secured in an hour. I mean, it's a lot of money. If they can do it, why can't we do it? Yeah, it makes you think about the whole process along the way, doesn't it? So that's open banking. That's a big one for you. Another one for you is specialist lenders. Specialist lenders. Now, I was reported a few years ago, just after Mortgage Market Review in 2014, to report back that the mortgage industry was getting far too simple, far too easy. And I thought the role of the mortgage advisor was too simple, and you could get a computer to do it. Things have changed dramatically now. We now have specialist lending, and it's becoming really, really complicated. And there's a raft of specialist lenders brought in now to provide the money for this specialist lending. Now, the problem is there isn't that much business to go around yet. It'll grow, the pie will grow, but what you've got is a number of lenders in the marketplace who are waiting to make some big profits. Some of them are starting to get nervous. This year, you will see a number of mergers and acquisitions from specialist lenders. Thought you'd see a few more last year. You saw one or two. Charter Court, for example, is one example. This year, you'll see some more. The digital banking revolution, has it taken off? Kind of. Is it going to work? Kind of. A lot of startups occurring in the digital banking world. Starlings and all sorts of different names now. Some of them are doing well, some aren't. The platforms, the banks that set up using the internet to take money from investors to borrow out, peer-to-peer lending, that model's failed badly. So don't go there on that one. Now, that model's not working. Land-based stopped lending on mortgages recently. But what you'll find is that the digital banks are starting now to come through from the main banks. Royal Bank of Scotland, for example, NatWest, which has a brand, whether you like or not, they have a brand, not particularly popular. They've produced their new digital banking called Bo. B-O, I think it is, Bo. It's pretty cool, isn't it? Now, they've got deep pockets, the banks. They've just survived the PPI scandals. They lost a lot of money, billions, but they got away with it, and they're still trading. So they've produced a new digital bank called Bo. The others doing things too. They got deep pockets. They will survive the crunch. And I think what you'll find in a few years' time is the digital banking will just be the big 4, 5, 6 banks moving forward. The little startups just don't have that critical mass to get going. So that's specialist lenders for you. Some interesting ones for you. Generation rent. Generation rent. Now, my 4 children are all renting now. Yeah, they're all renting now. Age range from 19 to 20, 25, all renting. Generation rent, they call them. They've been renting for many years now. All people in their early 30s have been renting. The road I live in here in Cheltenham, about 60, 70% of the houses here are rented by professional people with kids, dogs, It's called generation rent. They've been caught in this renting spiral. But that's going to change. That's going to change because lenders are starting to require lower deposits, which allows you then to get a bigger mortgage. And the other thing is that rents themselves are starting to be taken into account when it comes to credit searching. So you do a credit search, you get a credit score, that determines your mortgage, particularly with open banking and APIs. Because your rent payments that you've made to the landlord for the last 3, 4 years will boost your credit score. That's a big thing, which will allow these young people to borrow huge amounts of money, 90 or 95% loan to value, and therefore they'll be able to buy. Now, on the same same content or same topic as that one. I call this one the USA style fixes. Now, for those of you familiar with the USA market, the States mortgage market, they predominantly have fixed rate mortgages, fixed for the whole term. You negotiate your own mortgage, don't you, when you take out a mortgage in the US, and it's fixed for the whole term of your mortgage. It's just the way they roll over there, it's fine. We're starting to see them coming through. This year you'll see more long-term fixed rate mortgages. I'm talking 10 years plus, 10, 15, maybe 20 years. With flexible redemption penalties, really good portability options built in. So no big deal about redemption penalties being paid, but you've got to be careful, obviously, with those terms and conditions. But the thing is, though, and this is the clever thing, the whole point about fixed rate mortgages, particularly long-term fixed rate mortgages, is you can eliminate stress testing. And the Conservatives in their manifesto are starting to talk about influencing the regulator to remove stress testing. Now, stress testing is a nonsense, really. Picking 6% to stress somebody to, interest rates haven't been that great for like 15, 16 years. Whether it will happen again, nobody knows. Doubt it. They've been hovering around the 2-3% mark for ages. But the point is, though, if you fix it for 10 years plus, you don't need to stress, do you? Because you've got a fixed rate mortgage for 10 years. So if you get rid of stress testing, that increases the amount of money somebody can borrow or they can afford comfortably, which will then allow lenders to look at the 95% loan to value. And then for a small deposit of 5% will allow the first time buyers this generation rent to move into the market. I think you'll see a big boost in the first time buyer market this year, which is jolly exciting actually, because it needs it, a good boost to the house purchase market. Not just the remortgage market, the buy-to-let market, but the house purchase market. It kicks off everything. You've got furniture companies, builders, they all do well out of it, don't they? Lawyers, estate agents, and that will boost the economy beautifully because that's what we need to do. Now, on that topic, talking about the opposite to generation rent, let's talk about the boomers. We fix this one in, can we? Let's put in there boomers. Boomers are aging. There we are, boomers are aging. Now, the baby boomers, as we call them, born from 1945 to about 1960, 62, 3, thereabouts, are aging, and they're all entering the market now for equity release. Talk about it more in a second. I was watching Nationwide's advert last night on the telly. You've probably seen it. Brilliant. Well done, Nationwide. Got this old couple talking about their equity release. And she's talking about the inheritance. She's really worried about it. He's saying, look, let's buy the RV. Let's go off down to the sunset. Let's go to France. Let's spend our equity. Oh, that's brilliant. Just clever. Once the mainstream lenders start coming into equity release, it really gets accepted by the main population. Now, they reckon, the Organisation National Statistics, that over 12 million people are over the age of 65. That's a big population. These people, of course, are ready for the equity release market. And on the topic of equity release, or ER as I shall call it, it's not the emergency room. I think that's did that squeeze in? It did, yeah. Equity release. That's all changing as well. What you're finding there with the equity release market is they're hybriding products now. There's a hybrid Rio product, the retirement interest only mortgage, somebody 50 plus who just wants to take out a mortgage forever but can afford the interest payments, takes out a Rio. There's no set end date. So 50 onwards, you could be looking at an interest only mortgage to buy your property or remortgage your property. You get a lump sum to buy the house, maybe a retirement village house. These things are all happening. But then what happens later, that then gets converted to a roll-up mortgage when you're in your sort of 70s, 80s. That's going to change the market, massively. You can just see how things work, can't you? People buy their normal mortgages, repayment mortgages, until the age of 50, they convert it to interest only, or they buy a new property of interest only, convert it to roll-up later. That's going to change things. Really excited about that market for you. So make sure you take your equity release exam. It's not difficult, but that's my last point for you. The last point I'm going to make, and I don't know if this will squeeze in here, but I'll sort of pop it in there for you. There you go. Qualifications are changing this year. Be aware. They are changing, not the syllabus. So if you do CeMAP, June will come along and things will change marginally, as they always do. But what you're finding now with the quals is that the regulator is starting to get a bit nervous. They want the qualifications to be upped. They're woefully inadequate when it comes to the specialist mortgage market. All right, if you're working for NatWest Bank and you've got vanilla cases every day, then easy peasy. If you're dealing in a specialist world where you're dealing with buy-to-lets, expats, bridging, second charges, all those things, you need to have more knowledge. The best thing for you to do if you're interested is to head out and register for the RO7 and the RO1 exams at the CII. Don't go the CeMAP route. They have their diploma. It's okay, but it's a bit long-winded, and it's all dissertation style as well. So, university lecture kind of essay style. CII, RO7, RO1, talk to me more about it if you want to. We support that exam for classes. It's really, really good. It'll get you up to speed. What you'll probably find, though, is the CeMAPs are going to be boosted somewhat in the next year or two. They're going to increase. I hope they don't increase the syllabus, because they just keep putting nonsense in it, all this extra stuff they don't need to. You need to boost the specialist lending side of things. More information about buy-to-lets, expats, second charges, bridging, Sharia mortgages, all these specialist things. They need to make that more in depth, more case study based, more real life, if you like. The world has moved on since they first devised the syllabus for you. So now I have my 10, there's 10, isn't it? So 10, 5, 10, yeah, 10 predictions for 2020 and onwards. Let's put the title in there for you, 2020 onwards. My predictions for the mortgage market. Let's hope they come true, because there's some really exciting things going on there for you. We'll keep you up to date all year with our live streams and podcasts. We've got our boot camp, which is being revamped completely this year as well. Lots of video-based learning, really good stuff. We're going to keep you informed and help as many mortgage advisors enter that market and look after the consumers, particularly the Generation Rent and the boomers. You need to be able to look after these people along the way. Hope that's been useful for you. Bye. Alrighty, so that wraps up our first live stream of the year. Don't forget to ping me any questions you want me to take care of. Quick drink of my cup of coffee, which is very enjoyable coffee. Got that for Christmas actually. It's ground coffee. Got a little grinder for my coffee. It was very nice. Right, lovely Christmas present. The boot camp, just get the chance to ask questions. I can cover them for them. We put a HD version on the boot camp for you. This goes onto YouTube, so you can watch this at your leisure as well. I'm arranging to see you again next Monday, hopefully at 9 or 10 o'clock. I'll keep everybody posted and informed as the date, and we'll see you soon. Bye. There you go.